In May of 2009, Bill Gross coined the expression "new normal" to describe what he believed would be a 3 to 5 year period of below average growth for the U.S. Well, just yesterday, he revised his outlook, saying that, here's a quote, "there is only a new normal economy at best and a global recession at worst to look forward to in future years." Well, he joins us now live from Newport Beach, California, to explain just what this means for investors and whether the world is on track for the best or the worst case scenario. Bill, welcome to Street Smart. Great to have you. So what are the odds of that best case scenario, and what are the odds of the worst case?
Well, the worst case is obviously a recession. You know, the new normal, Lisa, is really a slow growth global economy over a longer period of time, as you mentioned, 3 to 5 years, fluctuating between 0 and 2% for the developed world, and that reflects the burden of too much debt, as we all know, and as well the negative effects of technology and globalization on future employment. And because developing economies are not affected to the same degree, their growth should be 3 to 4% absent a systemic collapse. We don't suggest that's coming, but obviously markets these days give mild signs of a collapse in any case.
Well, where do you put the odds of a global recession at this point? Is it 50-50? Is it 75-25?
Well, a global recession has to be defined. We would suggest that the odds of a developed economy recession are at least 50-50. I think Euroland is already in one, and the United States is on the brink. You know, the third quarter in the United States is probably going to show 1 to 2% growth, but after that, you know, we have the distinct possibility of moving below the zero line, and before that, having that show up in higher rates of unemployment and lower jobs gained, as we'll begin to see on Friday.
Bill, it's Adam here on the floor of the New York Stock Exchange. So at the end of the week or at the end of the day, when you find out that you got X more millions, or in your case, hundreds of millions of dollars that came in on that given week, what do you do with that fresh money? How do you deploy it, if you deploy it at all?
Well, Adam, what we try and remember is that there are periods of time when you're concerned about the return on your money, periods of time when you're concerned about the return of your money. That's an old Will Rogers adage. I think this is one of those times where you're more concerned about the return of your money. That doesn't mean, of course, that you stuff it in a mattress and you're asking, you know, basically me as a representative PIMCO where we would put it. We would put it certainly in very safe, sovereign types of assets, AAA rated countries. The United States would be one. We've done well with treasuries, believe it or not, in the last few months, although we were underweight and light at the beginning of the year. We've done well in the United Kingdom. We've done well in Germany, Australia, and Canada. So you want to look for countries with relatively clean balance sheets, with AAA types of ratings, and with the ability, importantly, to print money as opposed to not print money.
Hey, Bill, I do want to share something with you. I took a look at a graph. I graphed the 10-year Treasury really after the debt downgrade versus a credit default swap index that really looks at investment-grade corporates. And we've seen corporates widen out quite a bit. When you talk about what's safe outside of governments right now, where do you find that? We're seeing credit default swaps widen out so dramatically, hitting all-time highs. So where in the world of corporates are you putting money right now?
Sure. You point out, Lisa, that sovereign credit, has moved into the world of credit as opposed to the world, as we called it, the world of rates. And to that extent, to the extent that even AAA-rated companies are widening out in terms of spread, that basically means that nothing below it is safe. What we would suggest is that the safest types of investments below sovereign governments that I mentioned, would be in the mortgage area. We like agency mortgages because the Fed is going to be buying them because they yield, 3% plus or minus, as opposed to 0.5 to 1% in the short-term portion of the Treasury curve. And so, you can pick up an agency guarantee with a yield that obviously isn't what it used to be, but is much better than what the Treasury and the Fed in conjunction are offering these days.
And given the focus on Europe these days, you mentioned, I know this in the portfolios, looking at the asset allocation, you have a decent amount in Western European countries. At what point do you start to get concerned with a contagion throughout the Eurozone and start to look at the peripheral economies as being at serious risk?
Well, that's certainly been the case with the three little pigs. And now Italy and Spain are perhaps close to that same distinction. We've avoided them. We own basically the UK, we own some Germany, we own some France. Those are countries that we consider to be relatively clean shirts as opposed to dirty shirts, and that offer a decent, not necessarily a super attractive type of return. I think we should remember that Japanese long-term rates at 2% are quite close to what we see in the United States at 2 3/4, and certainly what we see in Germany at about the same yield. And so, these longer-term markets are now moving down towards Japanese territory, which suggests a long period of time of slow growth or no growth and a very low rate of inflation. Now, we don't necessarily think that that's the case in these developed markets in terms of inflation. And so, those particular markets are becoming extended in terms of their lower yields.
Bill, how long do we have to be patient? Is it 5 years, 10 years? How long do we need to sort of sit on our hands and wait for this new normal to play through?
Well, the biblical phrase, Adam, of 7 years of fat and 7 years of lean, it doesn't have to be that way, but Rogoff and Reinhardt in their book, This Time Is Different, basically point out to some type of symmetry in terms of the good and the bad. I would suggest that if the good was 20 years, we don't necessarily have to wait for 20 years for, a rejuvenation of the developed economies, but certainly the last three are just a beginning in terms of this rebalancing effort. What we really have is too much debt relative to equity, too much debt relative to purchasing power, and we're just going to have to go through a period of time in which, debt is brought down either fiscally or brought down through rebalancing on a monetary level.
Billy, you're obviously known for your prowess within the fixed income world, but let's talk about stocks. PIMCO has a number of stock funds. Are there areas within the stock market that you think have been overly penalized for sort of fears about what's happening on a global level?
Well, we think so. The developing markets are, I guess, the best example. The developing economies are exhibiting 3 to 4% growth as opposed to 0 to negative growth. The problem with the developing economies and their markets, their equity markets, is that historically money has been taken out of them, and they have delevered those markets basically as a flight to quality. What I think investors have to realize going forward is that certain countries, such as Brazil and perhaps China, are economies that are here to stay, and that this escape from their equity markets as a safe haven type of flight is really a thing of the past as opposed to a thing of the future. So we would recommend, for the most part, if you want to take equity risk, certainly do it in developing space as opposed to developed space. You want to go where the growth is.
Let's talk about today's events. Federal Reserve Chairman Ben Bernanke obviously providing testimony. He's come under a lot of scrutiny for his policies. And what I hear often in his testimony is sort of pointing back to Washington, D.C., saying, look, fiscal policies have to change in order for monetary stimulus to work. What's your opinion on what the Fed can do at this point and what they should do?
Well, I think his emphasis on fiscal emphasizes just that he knows that there are very few options that he has, as a Fed chairman going forward. Not that he can't get in that helicopter and disperse trillions of dollars worth of credit, which is possibly something that lies ahead. But what he's done up until this point with QE1 and QE2 is focus on the cost of credit and the availability of credit. The amount of credit, yes, has been expanded to $2 trillion to $2.5 trillion in terms of their balance sheet. But, in our opinion, what the Fed has to do and what the ECB, importantly, has to do as well is increase the amount of credit. Their balance sheets have been relatively static in terms of the amount for the past 6 to 12 months, and the private sector is delevering. What they need to do is match that delevering with a check of their own. And so not just the cost of money, which is what the twist has done, but the amount of money and the amount of balance sheet is what Ben Bernanke and the ECB have to do.
All right, Bill, we got to leave it there. Do appreciate you joining us here on Street Smart. It's been a pleasure. That, of course, was Bill Gross, founder and co-chief investment officer of PIMCO.